Good day, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. Strive is coming out with a variable rate Series A perpetual preferred. That is right, they are giving strategy competition. And we all know by this point that fiat credit is a dusty cassette player that your dad still keeps in the garage, while digital credit is the flamethrower that is duct taped to the Tesla Roadster that is orbiting Mars. Bitcoin has lit the fuse on this new financial revolution, and Strive is the latest that is volunteering to steer the rocket. We all know that the global bond market right now is a decrepit carnival ride that is wobbling on rusty bolts, and Strive is slamming a brand new turbo engine under the seat, telling the carny to hold their beer and flooring it. While the fiat world is still arguing about whether money printers cause inflation, Strive is siphoning their fumes, turning them into sats and handing you the receipt. Digital credit meets Bitcoin revolution. This is the future. Welcome to the craziness. Try not to spill your popcorn. And before I get started breaking down this incredible new instrument, I really want to thank Horizon for sponsoring this video. Horizon helps you buy Bitcoin using the home equity that is trapped in your house. And there's no debt, monthly payments, or term limits. The Bitcoin is fully yours to custody however you would like with no risk of forced liquidation. I will talk more about them at the end of the video. The link is in the description below. All right, time to crack open the hood on this beautiful mutant of corporate finance. Pretty exciting stuff here. It's variable rate, just like Stretch. That means the dividend rate can be varied. It means that the company is going to be doing yoga every single month to keep the share price limber, so you are holding an asset with a lot of flexibility. The offering size is 1.25 million shares. That is $125 million face value. In TradFi terms, that is barely a rounding error. In Bitcoin terms, though, it is enough ammo to punch another crater in fiat's forehead. When it comes to distribution, Barclays and Cantor are the joint ringmasters here. Clear Street is the hype man. You need to imagine 3 Wall Street desk jockeys who have finally realized that the future is orange. They are about to push this thing onto Bloomberg terminals faster than interns can break their coffee machine. And the listing target is the NASDAQ or the NYSE as soon as the paperwork stops smoking here. The moments that compliance signs off, Sata will be shotgun wed into the public markets where yield junkies will refresh level 2 quotes like Reddit degenerates waiting for stonk emojis. So Strive has built another Bitcoin Trojan horse into the legacy system with the ticker Sata, S-A-T-A. And Wall Street's about to wheel it straight through the gates to chase a 12% coupon. So we're going to sit back, watch the fiat walls catch flame, and we're going to enjoy the show. This is another example of Bitcoin eating the legacy system. So why are they raising this capital? Well, it's really simple. They are listing out a few reasons why they're going to target the net proceeds for different strategic growth initiatives. Obviously, they want to buy more Bitcoin with it. That's the first stop on the shopping spree. Strive is going to say, give us your soggy fiat. We will transmute it into immutable laser rock and pump our Bitcoin per share stats like a bodybuilder that's on pre-workout. They're also listing other reasons in their document like working capital and income producing assets. Obviously, CapEx is in there, which is just fancy corporate code for buying bigger because the current buckets are not big enough for holding all the Satoshis that are going to be incoming. And something interesting, they also listed the potential for share buybacks because nothing says that we are so undervalued it hurts like lighting common shares on fire. Share buybacks are always pretty stupid in traditional finance fiat land. However, they're pretty smart when you're trading under the value of your net assets. Any share buybacks that you conduct under that level means that Bitcoin per share, the Bitcoin exposure, increases for the shareholders. So Strive would be torching its own paper, but the float shrinks and the Bitcoin denominator stays exactly flat. And of course, they could pay down debt. However, they have an extraordinarily clean balance sheet. There is no convertible debt on this thing. They already have 5,958 Bitcoin, and that is before Semler's Bitcoin is added to the balance sheet. So when it comes on to this capital raise, it's not about survival. It is about them weaponizing the Bitcoin capital. Strive gets it. The things that you can offer the marketplace with Bitcoin as your underlying collateral base, they are better than anything else out there. The fact that Stretch from Strategy is getting competition already, and it's this brand new, means that this space is evolving so rapidly. It is the most exciting transformation in the world. And this is the Dividend engine. This is the mechanical heart that's going to be pumping cash through this Frankenstein of finance. And this is what I've been saying lately. The dividend rates that Strategy's been paying, the spread between the Bitcoin CAGR and those rates, I think that there is room for a bit more, and Strive is providing just that. So when it comes to duration, right, the yield curve, duration, this instrument, Sata, is the closest to stretch out of all the other strategy preferreds. It is more short duration than the others. However, it's paying a 1.5% more dividend rate right off the bat. So 12%, so that is 12 pennies on every dollar wired exactly to you on the 15th of every month like clockwork. It's a high yield espresso shot delivered straight into your brokerage account, the perfect pick-me-up for anyone allergic to 5% T-bills. And this is really cool. There is a board reset mechanism. Each month, the directors will gather, they will sacrifice a SOFR spreadsheet, and they will decide if the rate needs a trim, and they are going to face 2 electrified guardrails. Any cut is capped at 25 basis points plus whatever SOFR drifted since last month, which is about as gentle as shaving with a butter knife. And the rates can never sink below the current 1-month SOFR, meaning the coupon always keeps at least one nostril above the waterline of risk-free returns. And there are cut restrictions as well. Management of Strive cannot touch the coupon for a full quarter, and only after the share price has lounged above $100 for 20 straight trading days with every dividend current. So you're saying, Adam, this is too complicated, I need a translation. Well, here you go. Before they tighten the faucet, the market must already be partying in premium territory. Your cash flow is up to date and the auditors have signed off. Until then, the 12% fire hose will stay wide open. In human terms, Sata's dividend is going to behave like a luxury sports car that refuses to leave the driveway unless the GPS says the road ahead is freshly paved. It's going to tear away at 12% until the board can ease off the throttle in tiny increments if the road turns downhill and the brake pedal is locked for the first 3 laps. The yield hunters are going to get their spread, the regulators are going to get their seatbelts, and the fiat system is going to get a view of the taillights. Now, when I mentioned the 2 electrified rails, well, there's $95 on the floor of this thing and $105 on the ceiling. And management's plan is very simple. Keep the beast in this Goldilocks zone between $95 and $105. If it's below 95, well, just cue the panic button. The board could then crank the coupon like a mad scientist juicing Frankenstein. Higher yield, bigger bait for investors. The price will float back up. Think of it as financial helium. Above $105, well, you can pop the champagne but hide the scissors. Strive management could then politely shave a few basis points off the coupon so the share price stops acting like a coked up meme stock. Less helium and more gravity. And the result is a self-correcting ecosystem. The investors can enjoy predictability and the traders get a very tight playing field here, and the board look like geniuses for installing a thermostat on market emotion. And every turn of the yield dial is backed by Strive's favorite hobby, buying more Bitcoin with other people's fiat. So if you're sick of watching preferreds wander the desert like dehydrated camels, Sata gives you a nicely fenced dog park here. The price chases squirrels between $95 and $105. The management whistles and the coupon is the leash. Welcome to the most polite roller coaster in high yield land. The screams are optional, but the seatbelts are mandatory, children. Time to meet the carrot and the iron-fisted stick that keeps Sata's cash faucet flowing. There is a reserve account. So this is important. At closing, Strive forks over $12 per share, a full year of 12% dividends, and are locking it in a segregated vault. Think of it as prepaid alimony for yield addicts, guaranteed, notarized, and chained to the floor. If management tries any funny business, investors already have a full year of dividends waiting in the glove compartment. And there's also a missed payment escalator, kids. Should Strive ever forget date night with you, the unpaid dividends start compounding at 12% plus 25 basis points. Every month, the penalty steps up another 25 basis points until it hits a mafia-approved 20% cap. And this combo right here really is elegant, folks. The reserve says, relax, this first year is on us, while the escalator hangs a 20% sword over any CFO who thinks skipping a payment is smart. You hear that, Mr. Workman? Don't be skipping the payments. Together, these two things are going to turn Strive's dividend promise into something scarier than a margin call and safer than a Swiss bunker filled with canned sardines. So if you hold this thing, you're going to get your timely cash. Obviously, it's pretty safe. Just my humble opinion. A behavioral shock collar for management is embedded. And this is just yet another reason why traditional preferreds look like wooden nickels compared to this Bitcoin-backed monster. All right, kids, before we pour more gasoline on this Bitcoin bonfire, let us review the panic buttons here. Trigger number 1, issue or call at any time post-listing, which means that Strive can yank the rug, hand you $110 plus any interest that you are owed, and shout, "Thanks for the loan, nerds," which is a tidy 10% capital gain on top of all those fat monthly checks. That's like a golden parachute that's just stuffed with sats, okay? And there is a partial call floor as well, which means they cannot nickel and dime you. At least 50 million bucks of Sata must stay in the cage after any selective redeeming. So no sneaky share starving shenanigans, okay? There's also a cleanup call if the float shrinks under 25%, which means you need to picture the management of Strive sweeping up the last crumbs, paying the then current liquidation preference plus accrued dividends. If the price has been ratcheting upward, your exit ramps with it, which is a good problem to have. And also a tax event call, okay? The government decides that Bitcoin is the financial equivalent of nuclear waste, okay? The same thing that the economists have been calling it for the last almost 2 decades. Strive pays you, then they close the blast doors and everyone goes home solvent. And then there's the fundamental change put, okay? So if Strive tries to merge with Blockbuster or pivot to ostrich farming, you can slam a red button and force redemption at $100 plus accrued. There are no hostage situations here. So the bottom line that I'm telling you, kids, is that every single scenario right here has a very clearly marked fire escape. Either you walk out richer or Strive pays you a premium to make you disappear. Wall Street loves optionality. Bitcoiners love asymmetric upside. And Sata hands both a get out of jail with interest card. And this is the ultimate hyper cool feature of this instrument, in my humble opinion. There is a liquidation preference ratchet. Think of a magic elevator that only goes up and refuses to recognize the down button. That is the liquidation preference ratchet. So obviously you start at $100, okay? Day 0, you own a claim worth a crisp Benjamin if the world ends. And every single trading day, it checks 3 different markers. Number 1, the hard floor of $100. Number 2, yesterday's closing price if a single share changed hands. And number 3, the 10-day volume weighted average price average, which is the market's rolling mood ring. And whichever number is higher, that becomes your new legally protected liquidation value. So why does this matter? Well, imagine Strive pumps out fresh Sata at 105 to satisfy ravenous yield zombies. Your liquidation floor ratchets to match, so if the company ever melts into goo, the receiver must shove at least 105 into your pockets. The elevator just climbed a floor. If the market decides Sata is the next hot meme and trades above 120 for a week, the 10-day volume weighted average price would drag your preference upward like a tractor beam. Your safety net follows the hype. There's no more watching the upside evaporate in a bankruptcy courtroom while the executives at Strive keep the Gulfstream jet. So in plain English, okay, this clause right here is a prenup agreement that rewrites itself in your favor every single 24 hours. It protects you from dilution, it rewards you when the price rips higher, and it gives Strive 0 excuses to shortchange the holders. The liquidation preference ratchet here is the corporate equivalent of locking gains on roulette chips before the croupier can sweep the table. And the reason why I like this is because another preferred out there could sit there like a stunned pigeon, but Sata is strapping on a jetpack and telling gravity to file a complaint with legal. To sum it up, this sentence here, this mechanism protects holders if new shares print above par or the market trades up, which ensures liquidation value. It ensures that it keeps pace with market appreciation, which is obviously going to happen, in my humble opinion, once the market understands understands what a deadly yield vehicle this can be. So stepping into the Thunderdome of Bitcoin-backed preferreds, we're going to look at which gladiator struts out covered in Satoshis. We have Strive's Sata versus Strategy Stretch. The launch yield, we're looking at a 12% monthly versus the 9% monthly that Strategy Stretch started at. Right now, it's paying a 10.5% effective, though. So right out of the gate, Sata is firing out with 12%, which is quite exciting. When it comes to board control, both companies are getting their variable monthly dial. So the same levers kind of exist. The difference is that Sata is starting at the top shelf of the liquor cabinet, and Stretch needs a step stool just to reach the Baileys, okay? And when it comes to the issuer call, Strategy can yank Stretch at 101 and Strive must hand over 110. That extra $9 difference is the hazard pay for riding shotgun on a rocket full of Bitcoin. It is the capital markets version of surge pricing. Have you ever done surge pricing in Uber? You get out of the Metallica concert and you gotta get home, but you have to fork over $600 for a ride. This means pay more if you want to kick out the yield tourists early. So as of right now, I just gotta say Sata is the louder, faster, high-octane cousin. Same control panel, but a bigger engine and a richer exit premium. So if Stretch is a comfy business class seat, Sata is a fighter jet with cup holders. Choose your vibe, kids. You have to just ask, why is Strive offering this? Well, to me, it's pretty obvious because 12% monthly is basically catnip for every fixed income boomer who still thinks that AOL is the internet. They're gonna pile in for cash, blissfully unaware that they are now cosplaying as Bitcoin maxis. Congratulations, Grandpa. Your retirement portfolio just joined the Cyber Hornet swarm. And then obviously they're going to take the IPO cash and turn it into instant Bitcoin conversion. The moment that the wire's going to clear, Strive is going to punt that fiat into the orange vortex faster than you can say hyperinflation. And each new Satoshi is going to drop the company's Bitcoin per share meter like a mic at the Grammys. Boom. The optics are going to be juiced. The narrative is going to be secured. And that variable coupon is the financial throttle, okay? In a bull market, the price might rip. The bond could then trim the coupon a hair. And then the cash burn falls and Strive just buys even more Bitcoin with the spare change. And then in a bear market, maybe the price would sulk below par. The board could then jack the coupon. The yield junkies would then swarm in. The price rebounds and Strive keeps stacking sats. Either way, the flywheel can keep spinning, flinging off dividends and sucking in cheap capital like a Dyson possessed by Satoshi's ghost. And this is a feedback loop that's going nuclear. That's why these perpetual preferreds are so incredibly powerful. Bigger Bitcoin stack equals better optics equals lower cost of capital equals more preferreds issued inside the par band equals even more Bitcoin. Repeat until the fiat system screams for mercy or the moon runs out of real estate. So the bottom line here, my dearest little goblins, Sata is not just a security, it is a perpetual motion money machine fueled by yield greed and Bitcoin gravity. It is an economic Rube Goldberg device that ends with fiat face planting into a wood chipper while shareholders toast with orange cocktails. So let's peek behind the curtain and inspect the trap doors before we keep guzzling the 12% gasoline. Number one, coupon discretion. Remember, the board holds the scissors that trim the coupon, so governance matters more than your cholesterol numbers. Luckily, the prepaid dividend reserve is a pit bull that is chained to their ankle, and the 20% compounding gravity is a shock collar. So management of Strive can either decide to behave or get zapped. Number two, there's obvious Bitcoin price volatility. Yes, Bitcoin rides a roller coaster designed by Salvador Dali. However, it's a lot less volatile as of late if you've been paying attention. But Strive can obviously hedge that madness by parking the proceeds in boring cash gushing assets alongside their orange coin stack if they really want to. Number three, liquidity concerns. There's only 1.25 million shares initially. However, I just gotta say, looking at the precedent of how often these shares are trading, the trading volume of the strategy preferreds, this shouldn't be an issue. There is plenty of liquidity. And remember, I already said if a regulator decides Bitcoin is some controlled substance like it's meth, well, the investors get clean exit doors. Remember, tax redemption and fundamental change puts lets the holders cash out at par plus dividends before the bureaucrats could finish sharpening their pencils. Now, these guardrails do not eliminate risk entirely, obviously, but they turn a potential demolition derby into a Formula One race with roll cages, and also fire suits, and also an ambulance idling trackside. You can proceed with confidence, but keep your helmet on, okay? But if you're investing in this thing, you probably already know that a Bitcoin balance sheet is a lot safer than a fiat one. I think we're well past that point. So that's the presentation. 12% yield paid monthly sounds pretty good to me, but remember, it is variable rate. We are living in very exciting times. Strive is coming to compete with Strategy. They want a piece of the fixed income pie, and this is the most exciting capital markets transformation in the history of the entire world. My name is Adam Livingston. I am the Bitcoin Wizard. If you like this content, please like this video, subscribe to the channel, and send this to your friends and family who need the better fixed income than those crappy US government bonds, okay? Have a terrific day. Do not party too hard. Class dismissed.